Hi everyone. In the last video, we looked at different markets and their advantages and disadvantages. Once we decide which market we want to trade, the question then becomes, which stock category will we focus on? In this video, we will discuss what the market cap of a stock is, how it affects the price movement of the stock, and the different categories of stocks according to their market cap. First, let us define market cap. It refers to the total dollar market value of a company. The formula to calculate the market cap of a certain company is to multiply its stock price by its number of shares outstanding. The shares outstanding is the total number of shares that the company is divided into. This includes the shares traded in the market plus the shares that are owned by insiders, such as the CEO and the CFO. The insider shares are usually restricted shares, which means that they cannot be sold on the stock market. This brings us to another very important definition. That is the float. It is the number of shares that are available to be traded by traders like you and me, and it equals the number of shares outstanding minus the restricted shares. When a company decides to get listed on an exchange, it offers a specific number of shares that is decided by the investment banks and the management through what is known as an initial public offering or IPO. After the IPO, the float can change through several mechanisms like a secondary offering, a split, and a reverse split. But for now, we need to know that the float is the number of shares available to trade on the open market. Okay, so generally speaking, there are three broad divisions of stocks according to their market cap. Large cap or blue chip stocks have a market cap of over $10 billion. Mid cap stocks have $2 billion to $10 billion, and small caps are $300 million to $2 billion. Of course, those figures are just approximate. Further down are microcap companies, which range from $50 million up to $300 million. Then the nanocap companies, which are under $50 million in market cap. Okay, so how does all this fit together and how does it affect me as a trader? First, let me ask you a question. If a company has a market cap of $50 billion, do you think it will have a high float or a low float? Well, the scientific answer is we don't know. Since there is the factor of the restricted shares, remember that the market cap equals the share outstanding multiplied by the share price. So a company might have 10% restricted shares while another might have 60%. However, the practical answer is that it will generally have a high float in hundreds of millions or even billions of shares. The high number of shares outstanding and indirectly the float helps keep the share price reasonable. Because if our $50 billion company had only 50 million shares, that would mean that the share price would be $1,000 per share, and not many traders would want to trade such a high-priced stock. So, to keep the share price down, a large cap company must have a high float. On the other side of the spectrum, a small cap or micro cap company usually has a low float. This is due to the fact that the market cap is small, and if the float is huge, this would mean that the share price would be very low, and this could lead to its delisting from the exchange. Now, one more thing here before we move on. Sometimes when a company is having hard times, their share price keeps going down and may lose a lot of its initial value. These drops could be dramatic, and the stock might go into the sub $1 range. When this happens, the company gets a warning from the exchange for delisting if they cannot maintain their price above $1. So what those companies do is that they perform what is called a reverse split. Let me explain through an example. A 10-to-1 reverse split means that for every 10 shares that the trader owns, he will get instead 1 share with 10 times the price. So, if I own 1,000 shares of company XYZ and its current price is 50 cents, after the split, I will be owning 100 shares with a new price of $5. Same value, just playing with the numbers to legalize their listing. This has a very important consequence. It is that the float is divided by 10 in our example. Okay, so far I have been continuously mentioning float and stressing on its importance. So how does this float affect the price movement? As a general rule of thumb, high float stocks have less range and are generally less volatile, while low float stocks have big range and are very volatile. The less the float, the more dramatic the movement. There is no distinctive line between the definition of high float and low float. It all depends on the trader. Some traders consider anything below 100 million shares a low float, while others consider low float to be below 10 million shares. It depends on their perception of volatility. I personally consider anything below 50 million to be very low float and can have some impressive runs. Now let's look at two stocks and compare their price movement. First one on the left is MYOS, which is a low float biotech stock having only 3.25 million shares float. And the one on the right is Bank of America, which has a massive 10 billion share float. As you can see from the chart, MYOS has a huge average range of daily movement, or average true range, ATR for short, compared to BAC. Although the absolute dollar value of the ATRs are close, however, if you look at it percentage-wise with respect to the share price, MYOS moves 10 times as much as Bank of America does. Okay, so different traders have different personalities and different techniques. So one trader might prefer trading large cap stocks, while another might be willing to take more risk for more reward and hence trade the micro or even nano cap stocks. Let us compare them in the following table. From the share price standpoint, usually large cap stocks are more expensive than small caps. Float, large cap stocks have high float, while small cap stocks have low float. If we look at volatility, large cap stocks are slow movers, making an average of about 0.5 to 2% daily movements, while small cap stocks are very volatile and can have movements of 50% or more in a single day. If we look at risk, large cap stocks are generally less risky because the movement is tighter, while the volatility of small caps make them inherently risky. Trading style, large cap, high float stocks are usually not suitable for day trading, and traders usually swing trade them to be able to make a reasonable profit. They also appeal to long-term investors who look for value. Small caps, on the other hand, are suitable for day trading, but they are riskier if you want to swing trade them due to a possibly exaggerated overnight movement. Okay, so who trades those? Large caps are usually traded by institutional traders, hedge funds, and investors with big money to be able to buy a large number of shares and hence make a decent profit on such a tight movement. While small personal traders, which are also called retail traders like us, usually trade small caps due to their lower price and high percentage reward potential. Okay, last point is liquidity. Usually large cap stocks are more liquid than small caps and have much higher number of shares traded per day, unless the small cap stock has some great news and attracts a lot of traders. In that case, it will become very liquid. Okay, so as a conclusion, lower price, lower float stocks are generally good account builders if you are starting with a relatively small account and you want to grow it fast. However, due to their inherent risk and extreme volatility, you need to be extra careful and have much more discipline while trading them. If you have a large account and are looking for the less risky stocks to make some money, then large cap stocks might appeal to you. In the next video, I will talk about how different traders analyze the stocks to decide whether they go long or short or just stay away. Thank you very much and see you next time.